The main findings from the July Red Book is that the inflation lockdown that began about a year ago is really starting to bite. Sentiment-wise, we're continuing to see some of the bleakest reads outside of the early 90s recession. The combination of cost of living and interest rate increases is bearing down heavily on family finances, the mortgage belt, low and fixed income groups in particular. What the data is also starting to show is that households are starting to draw down on those excess reserves they accumulated during COVID. About 20 billion of the 260 billion that was saved over the 2020 and 21 period has been drawn to buffer against these pressures on incomes, and we're expecting to see something similar over the course of the rest of this year. In fact, that pressure looks to have ratcheted up a notch in the June quarter. The quarter saw a significant acceleration in fixed rate loan roll-offs and also another couple of interest rate rises from the RBA. Our Westpac card tracker index is showing that card activity likely contracted slightly in nominal terms in the quarter as a whole, with that weakness continuing into July. For spending in the national accounts, that may hold up a bit better. We think it'll be about flat. There's some items outside the card tracker data, vehicle sales for example, which are logged when delivered rather than purchased, and they look to be up about 5% in the quarter. But certainly the pressure is continuing on household incomes, and we're starting to see clearer signs that consumers are starting to wind back spending. It's not a capitulation. There's still discretionary spending happening. You know, we saw a pretty quick sell out of Taylor Swift tickets in June, but where it's happening, it's fewer and far between, and we're seeing this more general trend towards economising and winding back on discretionary spend. Well, the main positive is around inflation. We are clearly seeing inflation having passed its peak in Australia, and especially offshore, where we're seeing quite a rapid deceleration in inflation out of the US back to a 3% annual growth pace. And that promises to see something similar in Australia. At the same time, inflation expectations have still been quite well behaved. You know, on the consumer space, we've seen some easing in higher inflation expectations, and as that inflation slowdown becomes clearer domestically, we should see a continued easing inflation expectations, and that just makes it easier for the RBA to achieve a sustained return to the 2 to 3% target range. We also know that sentiment will respond likely pretty quickly to a definitive easing in the inflation and interest rate situation. So we know that's happened in the US, and in previous months where the RBA has paused, you know, there has been a lift in sentiment quite clearly. The problem is that at the same time that this sentiment story around inflation and interest rates may be improving, we expect the slowdown in the economy to become more apparent, and we are expecting some turn in the labour market. So at the moment, the consumer sentiment reads we've seen over the last year have been the weakest outside of the darkest days of the early 90s recession. The big point of difference between now and then is that unemployment was shooting 2 to 3 percentage points higher in the early 90s, but it's held at very low levels, around 3.5% in Australia this time around. So what we may lose around an improved inflation and interest rate situation, we may see some deterioration around job security in the labour market situation.